had a death cross here where the 50-day goes under the 200-day, and then price falls, right? That's what we have here. And you would know this with a declining 50-day average. When the average starts to curve, you sell, you know. And they had a little gap down here from a bad earnings. And then currently it bottomed at the 180 mark. I actually had a call option or a couple call options at 180, and I got out about 192 a while ago. Because this is how death crosses work. And see, you have to be extremely careful who you listen to, because a lot of times they don't know what they're talking about. It might go up 10%, 5%, and then you're just the liquidity to get out. Right here it popped, but that means absolutely nothing, especially if you look at the MACD. It's positive, and this is basically the highest that it's been since the death cross. So yeah. And then how that works is you got a low RSI here. It's the RSI. It's extremely low. Here it's below 50. It'll probably go down below 30 again. Now it's hard to read this, okay? Because once the death cross happens and it crosses over, the price declines. It's hard to read it. Because it could go either or. This 193 could go to 200, right? It could go to 210. Or it could go back down to 180. That's just how it works. So you have to get in at the bottom usually. You got that strong rejection right there. That's a strong rejection in price right there with this wick. That's a strong rejection. So you have that strong rejection there. That's telling you that it's not going no lower. That's a key sign. But then with the 50-day, that becomes resistance a lot of times. So what will happen is the price will go up. So let's say the price goes to 210. The 50-day then becomes resistance for the price, and then it pushes back down to 180 or lower. And then the price then inverts into an uptrend. It'll just keep going down. Nothing right now is positive when it comes to Tesla. If you're going into a more fundamental avenue and you just look at line charts, if it breaks below certain prices, I believe it's in the 180 range, then it's going to 130. So you just have to be careful. Dollar cost averaging is always the best way to do it, especially if you put in large sums of capital, like 5, 10, 20 grand a month. You just want a dollar cost average. You want to just pick one day a month and just put that same amount in, and you'll just average out. If you're swing trading, a death cross usually lasts between 3 to 6 months. So, you'll get your entry if it goes to 130, save capital for that too, but then it'll invert eventually. It'll go back up, unless the company is going under, which is unlikely, so it'll go back up. And then you're looking at, 260, 300 prices like that. new highs. Usually, this is a good trade, and you'll wait till that average declines a little bit more so you can get a better feeling. And then as soon as it starts to invert, that's when you jump in, and then you'll get the golden cross. The price of a pop above, the price of a pop above the averages, and that's usually my exit, depending if I'm dollar cost averaging. If I'm dollar cost averaging, then I might take profits and wait for it to come down and get back in, But for a trade, that would be my exit. Or a little while into the average to new highs. It just depends on how much money you need to make. Depends on how much money you put in. I mean, if you put in $100,000, you got call options, or which I don't suggest for anybody that's a new trader. Do not buy call options if you're a new trader, because you don't know what you're doing. You're gonna lose all your money. If I have call options, then I don't need that much of a gain for me to get out. But if you're going long, dollar cost average, and you just take profits and you buy it again when it's lower, it is what it is. It doesn't take too much thought. Now, Elon, he wants the price lower so he can have more control of the company. So you'll see a lot of propaganda. But yeah, the 50-day turns into the 50-day will turn into resistance eventually. And the price will descend with the 50-day. That's just how it works. It happens mostly all the time. It might even pop above it, but it's coming right back down to the 50-day and follows it. This is also why I say the 50-day is a good metric for price of what something is worth. Because price usually follows the 50-day everywhere. Like, it doesn't follow the 200-day or the 20-day. Like, it follows the 50-day. But yeah, you guys will be down for a while, and it's okay. It's good entry points. It's how you create wealth. You just let it go down. You let it bottom out as much as it can, and then you just ride it back up. This is how it is, Again, call options. You get a lot of people on Twitter or YouTube and talking about call options. It takes experience to actually trade call options. I'm an honest person. I'm just going to tell you the truth. If you don't know what you're doing, you're going to lose your money. I've lost money in call options. I think the most I've ever lost was like $150. I've lost money in call options. So I'm just telling the truth. Like, you can't, if you're going to trade and you don't know what you're doing, find somebody that has experience and try to give as much information as you can from them. Also, there are open source information that you can get, like college information, like business school information. You just type in a school that you like Harvard or whatever, and just look for the open source business program, and usually you can get free classes on whatever subject, if that's options or futures, real estate, whatever, but when it comes to trading, if you don't understand it, really don't try to take those risks, because you're not going to be able to win on the other side. And plus stocks are 100% safer than options, because options expire. So if you're trading stocks and you're down like this, all you have to do is just wait. If you're trading options, you have decay, price decay, and just different metrics that will cause price decay, time decay, price decay. There's different metrics that will cause you to go to zero. So it is no reason to play that game, especially with everything that you have. Just buy stocks. It's easy. You buy the stock, it'll go back up, and you'll make money. And I understand that some people don't have $100,000 to lose. So the safe way to do it is indexes and a couple top performers. That's just being honest. But all right.